Thank you everyone for joining. This morning we'll be presenting on global power trends for the decade ahead, looking at providing some key insights on some of the changing dynamics within the power market. I'm Jonathan Robinson from Frost & Sullivan. I lead our insights and analytics program within the energy and environment practice. So I cover everything from power generation, transmission and distribution, energy storage, and also really the new innovation areas of hydrogen and electrification are also coming under my remit. I have over 15 years experience in the power sector working with utilities, the big OEMs, down to sort of small innovation startups. So a real range of clients in our client base and companies that I've worked with. Today we're going to cover 8 different trends within the market and talk a little bit about their impact on the power sector for the decade ahead. So firstly, we'll talk about renewables and decentralized energy. Lots of activity there at the moment, has been for a while, but certainly accelerating further. Next, I will briefly touch on electrification and the implications of that. Next, I'll talk about a concept called virtual power plants, which are going to become increasingly important in our decentralized energy system. Next, energy storage, big growth market there, lots of projects across not just the battery space, but also non-battery energy storage. Electricity, the new oil, that's an interesting area where obviously the oil and gas companies are looking more at the opportunities within the electricity sector. The future of natural gas, we use natural gas for a significant portion of power generation, but also industrial demand. And obviously there's been a lot of factors influencing that market in particular in the last 3-4 months. Digital power, so this is both some content on the generation side, but also speaking a little bit to the investment that will go on in the grid. And finally, it could be in a briefing on its own, is hydrogen, but I do want to touch on that at the end. Okay, so first of all, where is the global investment going? So this is a slide that shows the situation in 2030, but actually we're rapidly accelerating to this point now. So in 2030, we're seeing nearly 600 billion being invested in the power sector. In reality, you're looking at the sort of 400, 500, 600 billion mark for most of the years across most of this decade. So there's huge global investment within the power sector. We have increasing demand for electricity, and that is and the need to decarbonize, the need to replace aging capacity. All of these factors are driving new investment growth. Now, what you'll see in the chart is the difference between what's renewable and non-renewable. And you can see there clearly, if you look through the bars, that solar and wind, so essentially the blue and the yellowy colours are, 80-ish, 85%, depending where you tie it, of where some of the investment is going. Huge volumes of investment there, and we're already seeing that. Solar is on track for potentially another record-breaking year this year. We are seeing a real boom in the potential for offshore wind. The UK is particularly strong for offshore wind as one example, but we're seeing lots of project interest throughout Europe, but also there has been massive investment in offshore wind in the past couple of years in China, and we're starting to see projects coming online in North America, and even in areas where offshore wind has not been so prominent before. We're seeing real momentum there. So Japan, it'll be a key technology. Offshore wind, very significant because of the amount of electricity generated, but I'll talk about that in a moment. We're also seeing on the solar side a lot of utility scale solar projects going ahead, but we're also seeing a lot more decentralized solar. So commercial industrial businesses, particularly with high power prices, are looking at investment in solar, and I'll talk about decentralized energy in a moment as well. Gas, I'm going to talk about a little bit separately. So we see gas investment lower, but there is still gas investment in some of the regions for sure. And we also see significant new nuclear investment in China, and in the longer term we could see more nuclear investment in other regions as we see small modular reactors and micro reactors potentially becoming technologies of the future. So this is a 2020 and a 2040 snapshot. Actually, it takes a while for things to change too dramatically in the power sector. There's a couple of headlines here. One you'll notice, and here we've gone for carbon, low carbon, and you'll notice that the low carbon portion of the market was just under 40% in 2020. So our electricity globally, 40% came from low carbon sources, much of that hydropower and nuclear. If we fast forward, you'll notice that's jumped to 70%, and the growth has been very much in wind and solar. And I mentioned you'll see onshore wind in many global markets, but also offshore wind really gaining momentum there as well. What I'd also call your attention to is that the amount of electricity generated has increased by about 50%. So globally, we still have a number of regions of the world, not just people who aren't connected to electricity, but people who are underserved by electricity, so they don't get a consistent supply, and they are still buying more devices that consume more electricity. And the volume of electricity that's going to be needed for air conditioning, for example, is going to be highly significant, particularly with the way that climate temperatures are going at the moment. If you've followed the situation in places like India, they've had a particularly aggressive heat wave, and people are, where they can, surviving in air-conditioned premises. Coal we see declining significantly, so we'll see a lot of coal closures over the course of this decade. We've seen a lot already, but we'll see the pace of coal declining. New coal investment will end around 2030. Gas is an interesting one. Gas is probably one of the biggest debate ones, and we'll see that later on. But we see gas as percentage declining, but we do still see it playing a role in the energy mix going forward, and I'll talk about that separately. Just to touch on decentralization then, so we see decentralization investment doubling over the course of the decade. So by the end of the decade, 25% of total power investment will be for decentralized energy. So that is mainly around residential solar PV and also commercial and industrial solar PV. Smaller amounts for hydropower, turbines and gensets, but it's really the solar technologies that are a big part of the story. I mentioned electrification. Now, there's a few significant aspects here. So electricity demand, as I mentioned, increasing for people who haven't got access, need access for air conditioning. So I mentioned all that. But what we will start to see is increases in electricity demand in the more developed economies. So in much of Europe, in North America, electricity demand has largely been flat for a decade. So any increases have been offset with energy efficiency savings. And what we'll start to see now is an increase as we see other sectors coming into play. So transportation, we will see the penetration of electric vehicles. 20% of new car sales in the UK, as an example, last year were electric, and we're seeing huge numbers of electric models coming through in particularly Europe. North America slower, so there'll be demand from transport, and that ultimately will add maybe 10-15% to total demand. We will see more electrification of buildings. So obviously you may think, well, electricity is fundamental to buildings. Well, yes, but there's still a lot of heating that's on fossil, a lot of water heating that's related to fossil, and we're going to see the greater use of, for example, heat pumps in buildings that will run on electricity. Same with industry. Industrial heat pumps will be another big trend, another big growth area. And in the longer term, we will see the electrification of more industrial processes. This is a difficult and challenging area. Most industry relies on fossil fuels at the moment, so furnaces, boilers are all fossil fuels. But in the future, we will see for some of those areas more electricity being utilised. And finally, the potential for electricity in aviation, although serious competition from hydrogen, that's really a longer term one. And the potential for shorter distance maritime to be electrified, so pleasure boats, ferries, etc., is not going to dramatically change the pace of overall electricity demand, that one, but it will be very significant for decarbonisation. So the point I want to get across is all of these individually will not massively have an impact, so they're not going to add 100% to demand, but if you cumulatively add them all together, then you are talking more demand for electricity. So how is the grid going to manage with all of this? Well, more grid investment, which I will touch on later on, but one area that this is going to be achieved is through something called virtual power plant. So a virtual power plant is essentially where you bring together a source of disparate assets across the electricity grid, and you optimize those so that you can really utilize the electricity generated where it's basically dispatching it to where it's needed. This will become more important as we have more renewable energy, because renewable energy at times, it's a lovely sunny day here in London. We have significant volumes of solar coming on. The weekend just gone was a great example. We had a reasonable amount of sunshine. We also had quite a lot of wind, and there was very high amounts of renewable energy in the system, more than we could really utilize. And that is going to happen increasingly more and more, and we need to find a way of not wasting that. And virtual power plants are going to be part of that solution. We're going to be able to connect the grid together better. We're going to be able to take that electricity produced over to more where it's needed. Just some market numbers to show you the kind of growth dynamics. So the market at the moment is a sort of $500 million market. It will be a $6 billion market by the end of the decade, with strong growth across all regions. So I know we're not just looking at Europe here, we're looking around the world, but it will be Europe and North America where the regulations and the market conditions will best appeal for virtual power plants. Where do virtual power plants fit in the wider energy system? Well, they've increasingly been acquired by utility companies, so they've been a way for utility companies to keep more control over their business, but they definitely slot into, these are sort of the people in the VPP ecosystem or where everybody plays. So the utilities are actively involved, the grid operators are involved in facilitating to make sure it happens. You've got the decentralized energy sources themselves. You've got a significant portion of analytics that's required. You've got the traditional trading companies that are able to look to support these solutions. You've got the VPP developers themselves, as I say, many owned by utilities, and then you've got the aggregators, which are often within the VPP organizations. There's a big overlap between those two that play a significant role there as well. Now, the other link to what I've just talked about, so how are we going to be able to utilize the electricity generated? Well, storage will be key for that. So this is there's a lot of technical terms within storage, so I'm not going to be going through all of these today. This is how we define our storage universe. So these are what we call use cases, where somebody who has an energy storage system can look potentially to earn revenues. Now, historically, till now, it's been what we called ancillary services that has been maybe the key. So it's all been about storage just being able to provide short-term storage to ensure that the grid is in balance. It's important the electricity grid is in balance. If it goes out of balance, we have massive power outages, you have major problems. That's been where the focus has been at the moment. Now, going forward, we're going to see more interest and more projects related to the integration of renewables, as I've mentioned. So we're going to see solar and wind projects that have storage co-located with them. There are already a number of mandates in North America, in key North American states, where utilities were going to have a percentage of energy storage versus their capacity by certain time periods. Excuse me. And we also will see more storage at the customer site. So by that I mean commercial, industrial, but also residential households having storage. And now, particularly with high electricity prices, storage is a really attractive proposition. So many geographies have seen increasing electricity costs. Certainly those listening within Europe will will be very aware that the energy prices have gone up for residential households, but also for commercial industrial customers as well. So avoiding those peak charges is probably the biggest incentive. There's also lower incentives to supply back to the grid than there were, and as I mentioned, the opportunity to revenue stack as well. Now, there are some restraints holding up the market. There are still some regulatory barriers in some geographies. There's not always subsidies. There have been some uncertain return on investment for projects. So when a market needs storage, developers come in, the market system works, the income potentially for some of those storage projects that are proposed therefore can decline. So that can and has restrained the market a little bit in the past, but the pace of renewables now, I would say, is really overcoming that one significantly. Again, just some numbers. So the global market was a 10.3 billion market in 2021. It'll be a 30 billion market in 2030. So significant growth there. And that is off the back of also declining technology costs as well. So our forecasts are for technology costs to have halved by the end of the decade as the scale up of lithium ion in particular really has an impact. Things have slowed a little bit in 2022. We're looking at the potential that projection might be a bit higher. So there is a bit of tightness on supply, but there is a lot of lithium coming on capacity going forward. Some of the regional trends, I'll touch on this very briefly. Latin America and Africa are relatively undeveloped markets for storage. There will be a few hotspots there, but they're going to have a slower pace for energy storage. It's really North America and Europe where the biggest activity has been. So North America, the US was a really hot market in 21. Europe, we're likely to see being a hot market with the EU's efforts for clean energy legislation and the Renew package that's come about because of Russia's invasion of the Ukraine. So that's certainly going to drive investment in Europe. And in Asia, we are going to see significant investment as well. So there's going to be a lot of investment in grid storage in China to support all that renewable energy. And we're going to see other regions within Asia catching up as well. Oh, I'll just skip back. So finally on storage, I've already mentioned this. I just wanted to call out the amount of investment that we're expecting to see. So we talked about the tightness of capacity. The global storage lithium ion battery manufacturing capacity. I should point out there are other chemistries other than lithium, and there are other aspects of storage, but this is just a focus in on lithium ion. And here what you'll see is that within 5 years, the amount of capacity for producing lithium ion batteries will have quadrupled globally. So much of that will go into the automotive sector. Much of that is in China, but the EU in particular has been taking strategic decisions to invest in gigafactories for battery production. The UK has been doing the same. So we've really seen a lot of development there. So everywhere increasing, but the EU, I would say, has been particularly on the money with this one in encouraging production within its borders to stop sort of dependency totally on other regions, which has been the case a bit more till now. So the next trend I'm going to touch on is oil and gas companies. So I mentioned electricity is the new oil. This is a trend we've been talking about for a little while. It may seem less dynamic in the absolute current moment because of the high price of oil and gas at the moment, but we're talking long term here. Oil and gas is still going to have play a role in our economy for a while, but the oil and gas companies are much more motivated to focus on the power sector. Even the more reluctant American ones have been starting to focus on renewables and on the opportunities in power as well. There's a number of reasons why that's been the case. The lower renewable energy project costs have changed the economic calculations. The pressure to decarbonize and be more sustainable. There's a lot of activist pressure on oil and gas companies to do that. The potential to electrify industry and electrify mobility, I've talked about, higher demand. Mitigating liabilities. Geothermal is a great way for oil and gas companies to mitigate their abandonment liabilities. Some of the operational synergies. Offshore oil and gas is highly technical, highly skilled. Offshore wind projects also require certain skills. There's a lot of transferability between the two. You can use offshore wind projects to power offshore oil and gas exploration, for example. So again, synergies there. Innovation, things like virtual power plants, some of the power trading, some of the concepts I've talked about have sort of changed this perception of the staid power industry. And finally, a couple of examples. NextEra, which is a US giant renewable company, and OVO, which has been very successful in the UK, have said, A, you can disrupt the market, and B, you can be profitable and big and successful doing it. NextEra is, billions and billion-dollar company, seriously recognized as being a major player. Quick case study example of Shell. So I expect everyone will probably be aware of Shell. So Shell, oil and gas company, still a big part of its business, but it has been targeting the power sector for some time now. So it was early on electric mobility, acquiring NewMotion to give it EV charging infrastructure. It acquired a utility in the UK, First Utility, which has given it 1 million in the customer base. It is looking to build this up gradually, although retail energy at the moment is a perilous place to be. So that the desire to have the customer to sell the energy is less important to them now, as opposed to the desire to have more of a relationship with a customer that will lead in more with the mobility side. Shell has been a big focus on renewable projects, so it's now its own developer. It's an investor, it's a developer. It's acquired even a floating wind company, which is very much an emerging business, that it's acquired into its offshore portfolio. And finally, it's a great way for it to sell its products. So Shell sells a lot of lubricants, a lot of oil-based products. These are needed still within, say, the wind industry. So it's been a growth area for Shell to do that as well. Skip back. So global gas power investment. So I said we'd be talking about natural gas. So roll back 10 years, everybody is talking about natural gas as the fuel of the future. Golden age of natural gas, the IEA predicted, huge volumes of investment, loads of gas power plants built, was going to replace all the coal plants that we've got. That reality has not quite come to pass. There is still investment in gas, but as you'll see here, it is declining in North America. So gas projects, the appetite for gas projects has slowed there. Europe has already been relatively low and is staying fairly low. So I know these figures of nearly 2 billion could seem significant in some contexts, but in European power investment, that's peanuts. Similarly with Latin America, we do see growth in Asia Pacific, and we do see still strong investment in the Middle East and Africa, particularly the Middle East. Both of these areas have good gas supplies. China is still focused on investing a bit more in natural gas. There are other coal geographies in the region that are at least looking to bring natural gas a bit more into the mix. So we still see the potential for some new natural gas, but it is certainly lower than we would have been telling you about in 4 or 5 years ago, beyond that. But there's a big move in the moment on the supply of gas. So Russia's invasion of the Ukraine has really been the shock that Europe has probably needed to look at its dependence on Russian oil and gas. So Russia supplies 30-odd% of Europe's gas, depending on the year. For some countries, it is near 100% if you get into the east. If you get into Western Europe, it's much lower. The UK's gas, I think it's about 4% of the UK's gas comes from Russia. Spain's is very low. Sweden's is negligible. So it does vary by country. Russia also a significant supply to China. What this has done is this combined with the higher oil and gas prices has driven a new wave of LNG investment. So LNG investment had been lower because of lower oil and gas prices in sort of 15-16. But what we've now seen is that the higher oil gas prices and the geopolitical situation has led to another round of project investment, which is not great for the sustainability aspect, but it is the reality of what's happening. So the US has been investing because it now wants to supply more to Europe. It's strategically, geopolitically good for it to be helping Europe to reduce its dependency. The Middle East is still investing more, has continued to invest, but Qatar's looking to do more, Saudi Arabia more, but keen to build up capacity a bit more. Australia, significant portion, is looking to do more. There's also more investment in regasification as well. So when I talk about LNG, I'm talking about the export terminals and the import terminals where it's regasified. And strategically, a number of countries that are dependent on gas are looking to do that as well. So we do have the next wave coming through before ultimately that should gradually slow towards the end of the decade. Right, linked to this, digital power. So a few different aspects here. Firstly, we see greater deployment of digital technology within the power sector to achieve cost savings and better outcomes. So a couple of examples here. The use of sensors is really one of the key aspects for this. So sensor technology is increasingly being deployed across power assets. Turbines has been done for a while, but it's now being done for other secondary assets within the power space, and there's still a lot more that can be done. And by having these sensors installed, the key thing is you can collect large volumes of data. You can use a combination of AI and machine learning to analyze that data, and you can therefore predict more easily what the outcomes are likely to be, what the impact on this equipment will be, when to service it, when to replace parts. You can optimize therefore the downtime that these assets will have. This is important, particularly in those situations where the asset is an asset that's a prime power asset, so it's something that supplies power as much as possible. But it is certainly a way of really reducing operation and maintenance costs that are significant. They're being deployed in gas plants, coal plants patchily, depending on the age. In Europe, not so much because the plants are nearing the end of their life. Certainly, they're used significantly in the wind industry. And my second example of a digital twin, this image happens to be for a turbine, but a gas turbine. But for a wind turbine, you would have the same thing. Each wind turbine will have its own digital twin. And even though the turbines, say you've got 20 offshore turbines sat together, the conditions, the state of each turbine will differ. And those turbines can be managed centrally from one location, and using the data that's provided, engineers and servicing experts can take the decision on what strategies to deploy. So there's a lot of investment and focus, a lot of companies that are active in this space, both in the UK, but in Europe, in North America, also Asian companies. So it's the kind of thing that's being offered by larger, Cisco style big software companies are engaging more in this. I mean, GE, Siemens, Baker Hughes, all this sort of stuff is key and paramount for them. But there are also smaller organizations that are looking to do it. And also utility companies are building up their capabilities more and more in-house to understand as much as they can about their assets. Looking then at further down the power value chain for digital. So this is power distribution. So power distribution is the archetypal traditional conservative no change industry. We supply electricity from A to B. We aim to keep the power on, and that's it. That is now changing significantly. These businesses are having to grapple with the fact that you have solar panels, you have cars, you have battery storage, all these different sources of generation coming online. So they're having to increasingly look at the offerings that they can give. They're being pushed by regulators to ensure that these technologies can be better integrated within the grid. So they are increasingly looking at deploying a number of the technologies I've mentioned, AI, digital twins, but they're using a number of other areas of analytics as well, cloud computing, edge processing. They're trying to bring a lot more intelligence into the grid. These are some numbers from a study that we've done about the sort of level of investment and how you'll see the growth changing across a few key geographies. As you can see, again, strong growth. It's Europe and North America where the focus of this investment is at the moment, but both of those, you're seeing the market nearly treble within a decade. So significant investment by them in some of the key core areas, which are really those things that enhance the customer relationships, those things that are really optimizing the grid, and connected businesses, which is where we would consider things like EV and storage. So all the big rollout programs for smart meters, for example, all the investment programs that the grids have to do in the UK, certainly every 7 years, to determine where they'll be investing and what they plan to invest on. All of this is building digital into those programs. I said I would speak about hydrogen. Hydrogen can be definitely a briefing in its own. It is the hottest topic within. It's not just a power topic. It is probably, I would say, the hottest topic within Frost & Sullivan that we are speaking about now. There is a huge level of interest in this across a number of sectors. The transportation sector, potentially for commercial. Larger commercial vehicle trucks, there's a bit of a focus there. There is also, as I mentioned earlier, aviation is looking at the potential for hydrogen. Maritime, some longer distance maritime is also very interested in hydrogen being able to be deployed. Industry is extremely interested in hydrogen for those hard to decarbonize industrial processes. I spoke about electricity and the role it can play. Well, hydrogen, particularly for steel, chemicals, some of those really heavy, the production of ammonia, fertilizers, some of those really fossil fuel intensive areas, hydrogen has significant promise to play a role. So we can see here, I've called out. I'm not going to go through all of these at all, but these are just the examples within Europe. Most countries have developed hydrogen strategies. They have targets on the level of investment and funding that they want to achieve. You'll see, everybody's well into the billions, and probably more investment will come through as we go forward. The focus very much on, I look at the Netherlands, 35 million per annum. That will certainly increase. They're all looking to build their own electrolyzer capacities within the country. And this is very important. I think it's a very important geopolitical aspect here. Countries do not want to make themselves dependent in the future on having to import hydrogen. There will be a global hydrogen trade, yes, in the same way there is an oil and gas trade, but actually there is a real interest from countries to say, you know what, we've been heavily dependent on importing fossil fuels for a long period of time. We want to try and avoid that is the case in the future, and that we have this under our own control. So big strategies therefore to build up electrolyzer capacity. North America has the same. The countries like the Middle East, Saudi Arabia, Australia, they're very keen. These countries are keen to be exporters, so the balance and supply of that will be really interesting. But certainly hydrogen, there is a lot of investment going on at the moment. To bring this back to the power sector, there is a lot of talk about the use of hydrogen within the power sector as a way of decarbonising natural gas. Now, in the immediate future, that hydrogen is really going to be, the priority is going to be, and the economics are going to work best for heavy industry. So the bulk of it will be used there. But the products, technologies being sold now into the power industry in the engine, turbine, other equipment space, the specifications increasingly are saying you need to have a good ability to handle a high percentage of blended hydrogen, going up to 100%. And there is the view in the future that, particularly if we get to a situation where hydrogen is relatively abundant, you've got excess hydrogen, you'll be looking to blend that with natural gas, and that could be a way for further decarbonisation of the traditionally natural gas power sector. This is the value chain for hydrogen. So I'm going to give you a quick introduction to the process. So generation at the moment can come from PV, wind, so gas, nuclear. It could be a potentially important area here because you can use some of the heat that's generated within the nuclear process to generate hydrogen. Really interesting area. We're just about to start some work for a client looking in more detail at that. Then you have the production via electrolysis. So that's the main process that's used, either high temperature, which is where nuclear sits, and the lower temperature electrolysis solutions as well. So it is effectively a fuel cell that is used in reverse. Then you have, and you'll need significant investment in storage, transportation, the infrastructure, dedicated hydrogen network. Can we reuse the natural grid? Will we need an alternative? These are things that are still being worked out, but the early opportunities will be in co-location. So you will be looking at the co-location of hydrogen production near where it will be utilized. That's where the early wins will be. And finally, you will see the end user opportunities, particularly industrial, as I mentioned, but there'll be other sector opportunities as well. But as I say, it's a briefing on its own. I think we're recording another briefing. My colleague Swagath Manohar, I believe, is doing one for you guys as well. So there will be, if you're interested in hydrogen, please look out for that briefing's availability as well. Okay, so I'm just going to come to the end of the presentation. So thank you everyone for listening and staying through. I would just like to make a few key conclusions and observations before we close. So decade of strong growth forecast for renewable energy would have been valid last year, is even more valid now with what we've seen geopolitically. Project costs under pressure now. Costs everywhere are under pressure, not just in the power sector, everywhere. There won't be people listening to this that haven't been aware that inflation is up, component supply is tight. So yes, things are tight at the moment, but the economics for all projects therefore are facing the same situation. But in the long run, we still see projects coming down further, particularly for offshore wind, which has achieved all the cost reductions already. Oil and gas companies are far more interested in the power sector, even with those higher prices. They are not going to suddenly become power utilities overnight. And actually, the classic utility business is not the bit that's primarily of interest for them, but as a developing renewable projects, large-scale projects, in building a relationship with customers, in some cases that will encompass electric mobility and local generation. More of interest, more focus, more activity likely to happen there. Digitally led innovation, definitely increasingly important. So we've seen a lot of digital technology development in the last 4 or 5 years. We're going to see more of that as well, but we're going to see the business models for it increasingly be there and the acceptance of it more being there. So companies are investing in digital, sometimes on a small scale. It's hard for companies to understand really what they need often, but they know that digital can help them improve their margins, improve their operational efficiency. They do it on a smaller scale, they achieve success, boom, boom, they look to ramp it up everywhere they can. And finally, storage and VPPs, key part of the decentralized story. So story, vehicle to grid, I should mention the car as well here. All of this is going to be part of that story. We're going to have more assets on the grid to manage, and VPPs will be a key element in enabling us to really optimize and get the best value out of our grid. So again, thank you very much for listening, and keep following the power sector for the developments ahead.
So thank you for everyone for listening to that. We have a few questions that have come in, so I'll take those now. I will encourage anybody else, if you'd like to ask questions, please go ahead. The first question that I've had relates to the impact that supply chain constraints are having on investment and on the energy industry. This is a really good question because obviously we saw the recovery from COVID, and the impact of that was that industrial demand really picked up. and there was a real tightness in supply in a number of areas. Probably the most famous, I think, was the automotive industry, where we saw quite a lot of shortages of key components there, big shortage of semiconductors, massive issues, delays in cars, etc. For the energy industry, it's not been immune to that as well. There's been a couple of aspects to this. One has been that we have seen quite a few delays of core components. So this could be things shipped from China, which has obviously kept its COVID restrictions in force, or even just other parts of the world. And it's sometimes been minor things. It could be something that's needed is what we call a balance of plant. So perhaps a relatively small part of the overall project, but something that hasn't turned up, that therefore there could be a 12-month wait on, delay on. So I think there's certainly been some slowdown in the completion of projects. The second thing actually linked to it on the materials side has been we've seen some price volatility of certain materials. So as we've had volatility of oil and gas prices, it's also been an impact on the materials side, which has definitely caused, again, some link to supply shortages, has caused some issues. So a good example on the hydrogen side for electrolyzers is something called iridium, which is in pretty short supply globally and is used as one of the key components of one of the main electrolyzer technologies. So that has become more expensive and harder to get. So that has certainly caused delays. So these are being felt within the industry right now. Obviously, the big uncertainty is where the global economy goes next year. The energy sector is reasonably resilient to an economic downturn because a lot of these are long-term capital investments. It's not easy to stop-start things, and really for our transition to net zero, we need these projects to go ahead. So it's not immune, but it is reasonably resilient versus some sectors where you really do feel the downturn more clearly. What of course will be interesting is if there is a bit of an economic downturn, does that reduce material costs, and could that gradually ease the pressure on raw material supply in 2023, 24? I think that's hard to call at the moment, but it is a possible issue. But obviously there is still inflationary pressures with energy costs within the sector. Another question we've got in, this is quite a specific one. A couple of quite specific ones I can see here. So bladeless small domestic wind turbines, is it the future or a myth and a con? There are always lots of these exciting new tech things out there that come along. You get a couple of smart people with a nice proposition and they win an innovation prize. Taking it to the next level is much harder. You possibly remember, a decade ago, if we've got a lot of listeners in Britain, Ireland, David Cameron, Prime Minister, was talking about, wind farms in the garden. B&Q was going to sell them, and that never really took off. I suspect this will probably be hard to scale up and to be realistic. So I wouldn't quite call it a myth and a con, but I imagine it will be hard for that to become viable. It's much more viable to be generating our wind on big scale. Offshore in particular is a big growth area there. Another question here, linked a bit to what actually I've already sort of partly answered, is what about what impact are higher energy costs having on the market? Does that mean there's more money for investment? So obviously we as consumers are paying high energy costs. The challenge is that the direct utility companies that are supplying us are not necessarily feeling the benefits of this. So if they themselves are having to buy oil and gas particularly gas for power at high prices, then for them they're not really making a profit on it. Some of the renewable generators are making decent profits at the moment. I know that the Truss government has announced a windfall tax on some of these renewable energy companies, so that's obviously going to potentially constrain investment a bit. So Yes, from some parts there is definitely more money available. The oil and gas companies like Shell and BP certainly have more cash available to put into financing renewable energy projects. So I would say that is a positive coming out of all of this. One challenge I would highlight that's starting to obviously come on the horizon now is financing for all of these projects. So debt financing for more than a decade now has not been an issue really at all. We've had nearly 14 years of cheap cash, cheap money. That's turning around now, as anybody with a mortgage is going to be increasingly aware. But that impacts the financing for big projects. So that's still being felt, and I think a lot of energy projects can still go ahead, but there are going to be some bumps in the road because projects that were worked on a financing cost of X are now going to have to deal with a financing cost of Y. So I think that's going to be a challenge that we're going to see coming forward next year. What is the price projection for domestic battery storage? So it depends on the market. It's a little bit variable depending obviously on the size of your home. Systems, I think for the UK, we're looking at somewhere around the £3,000 mark, I think. When I last looked, I'd have to double check that, but they are becoming certainly the cost in the last few years has gone down. In 2022, things stalled a bit because lithium prices were higher, but our expectation as this market continues to grow is that the costs will continue to fall. And decentralized energy is having a very strong year. I think the last thing I saw that solar installations in the UK, residential solar, was running, I think, at about 1,000 a year last year. It's now running at about 3,000 now. Many of these will have battery storage systems installed with them, because particularly with the high energy costs, the grid costs at the moment, if you're installing solar PV, then installing a battery storage system is a bit of a no-brainer, because you can store that and use it and avoid having to pay high charges at other times. So that will mean that the market will grow and get bigger, which will mean that prices should continue to come down. The other plus side is there is quite a lot of, although we're quite constrained at the moment, there is quite a lot of investment in lithium mining. I think I alluded to it in the presentation, but the lithium supply is certainly improving, and that should really help as well. Another question here related to electric vehicles. So infrastructure readiness for electric vehicles. How long will it take and how much will it cost to be ready for 100% vehicles being electric? Okay, this is, gosh, I honestly can't give you a number on how much at the moment. It's going to be a very, very, very significant sum to get up to 100%. We are finding at the moment, where you have a high penetration of electric vehicles, it can be a bit of a challenge. So I know I was speaking to somebody in the Netherlands yesterday, and they, I think, are finding at times the grid is facing some challenges with with a penetration of electric vehicles of, I think, about 10–12%. The very, very local grid. I think on a larger grid, it shouldn't be as much of an issue. But it is really important, certainly, that we need to think more about that level of investment. And actually, generally, European countries have still not got this right. They haven't, and the UK obviously included within this. We do need to invest significant sums in the background infrastructure, in the transformers, in the switch gears, in all the grid technologies that make all this happen. It's not impossible to do, and there's a lot of smart technology out there that can help to go with the hardware, but we do need to invest substantial amounts more to do this. But we can get to 100%, is my view. I think we will have to make sure that domestic households are fully connected to the grid in terms of when they charge, the best opportunities for charging at exactly the optimum time. All of these things are going to have to be built into anything that happens. One company I would call out for being quite good on this is Octopus. They're doing a lot at the moment to really try and work in this space, and they're offering quite a lot of flexible tariff packages that enable you to charge your car at night, and then it's an asset during the day. But we are talking billions of investment over time. But it is, I think, an inevitable thing to happen, certainly. Just seeing if we've got any more. We've got a few minutes left if anyone wants to come through with any more questions. I'll just double check there's none I've missed that have come in. No, looks like I've answered them all. So I thank you all for listening. Hopefully you found it interesting. I know we have other briefings that we'll be doing, and I'll hand it over for the wrap up. So thank you everybody for joining.